today Walgreens announced their earnings and the stock is up over 15%. And honestly, there's a lot of mixed results in this earnings report. So in this video, we're going to take a look at those results and I'm going to give my opinion on this company. So if you enjoyed the video, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. So as I mentioned, Walgreens went up over 15% here on the back of their earnings. However, year to date, this stock is still down almost 61%. And over the last 5 years, the stock has dropped over 80%. But today they finally got some good news. They beat EPS estimates by almost 10%, coming through with EPS of 39 cents per share. And they also beat on their top line by 5.5%, reporting revenue of $37.55 billion. So obviously a top and bottom line beat is a good thing. However, keep in mind that this 39 cents of adjusted EPS is still down almost 41% year over year on a constant currency basis. So yes, they did better than analysts are expecting. However, the business is still in decline. And their GAAP EPS numbers actually came in at a loss of $3.48 per share. This is being driven by a non-cash charge for valuation allowance on deferred tax assets primarily related to liabilities recognized during the prior period, as well as a non-cash impairment charge for CareCentrix and an equity investment in China. So basically this quarter they got hit with a lot of one-time costs that are not going to affect the business long term, and that's why this adjusted EPS number probably makes a little more sense to look at, but it's still not a good thing to see all these charges being hit against the business. I honestly think the biggest thing that investors got out of this announcement was more clarity around Walgreens' strategy moving forward. They announced that they are planning to close 500 stores in fiscal year 2025 alone, and roughly 1,200 stores over the next 3 years. This is a little bit more definition than what was previously announced back in June, where the company basically just stated that they were going to be closing a significant amount of stores, and there wasn't a lot of clarity around what that meant for Walgreens moving forward. And this is all part of Walgreens' broader strategy. Right now, they have a total of 8,700 locations in the US, and they have announced that about a quarter of those are currently unprofitable. So as they close down these stores, they have basically said that these closures are going to have an immediate accretive effect against the adjusted earnings. In other words, the closure of these stores is going to have an immediate impact in the positive direction for Walgreens' earnings per share as well as their free cash flow. And during the announcement, CEO Tim Wentworth said that the closure of these stores will create a healthier store base as well as enable the company to respond to shifts in consumer behavior as well as buying preferences. And all of these efforts seem to be having an impact already, as the company announced that it has already surpassed its target of cutting $1 billion of costs during fiscal year 2024. It's great to see these cost-cutting measures going in the right direction. However, Walgreens is still experiencing some pressures, especially around their pharmacy reimbursements. This comes down to the fact that a lot of these insurance providers are also looking to cut their costs. And what that means for Walgreens is they get less in reimbursements when they offer a prescription to a customer. So obviously this just impacts their margin, which means that they take away a little bit less from these sales, but they are actually increasing the amount of sales that they're making. They saw a 6.5% increase year over year, coming to a pharmacy retail sales of $29.47 billion. That is above analyst expectations of $28.09 billion. They even saw a 1.7% increase in their total prescriptions filled for the quarter. So right now, Walgreens is in a very weird spot because its valuation metrics are extremely low. The forward P ratio on this company is sitting at a 4.21, which is insanely low when you think about it. However, the question is, how much further do they really have to fall? And right now, analysts believe that this company has a lot further ways to fall because current estimates for 2024 for average EPS is $2.85. That is down from a year ago when they put up $3.98. And in 2025, the numbers just keep getting worse because the average EPS estimate is $1.75. So for me personally, I'm not looking to buy into Walgreens. I think there's just a lot of risk with this company. It's not to say that the company can't turn things around. If they really drive down their costs, maybe reduce their employee count, and start turning things around, I think that they could be in a good position. The problem is right now there's just a lot of competition in this market. We see Amazon getting into the pharmacy market. You also have CVS, and every time I feel like I drive past a Walgreens, there's a CVS within a block or two of the same street. And that kind of concerns me because I feel like with all the competition that's coming in online, I feel like between CVS and Walgreens, there's probably only one main player that can last in having a brick and mortar store. But keep in mind, that's just my opinion. Do not buy a company just because I talked about it here on YouTube. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, what's a mummy's favorite genre of music? Check the comments down below for the answer. Thanks for watching.